Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, New York City, we have Greg Rodgers. He's a partner at Latham Watkins. We're going to learn more about direct listings, and he also advised on Spotify and Slack, two very popular listings that we're very well aware of. Greg, it's great to have you with us. Welcome to the market site. Direct listings, sounds like you know all about this here. Tell us more about what they are and what's the difference between a traditional IPO.
Thank you. It's actually easiest to explain what a direct listing is by starting with what an IPO is. If you look at an IPO, it's essentially two events: one, a capital raising event by the company, and then the listing of its shares for future trading on an exchange. The direct listing is just the decoupling of that event, the capital formation from the listing, but we're only doing the listing part. So effectively all of the pre-existing shares become the traded listing shares on the exchange.
Why would a company choose to do a direct listing rather than do the traditional IPO?
Well, so far the two that have done it have been relatively large, successful companies, successful in their capital raising in the private market, such that they had no immediate need for the capital formation component, but they still wanted liquidity for their existing shareholders, including their employees. There's also the idea that you get more efficient pricing by going through a pricing exercise on the floor of an exchange versus the traditional underwriter-led process.
All right, and you mentioned that these are for companies that aren't looking for actual capital formation. What other factors do they need to think about if they're going the direct listing route?
Yeah, so that's the big one. I think if you need capital right now, you should stick with the traditional IPO process. Other attributes that we think are good but not necessary are a well-known brand name and a fairly well-developed existing shareholder base, since that's the base of shareholders that will form your listed shareholder base.
And what about the financial advisors? Because I would imagine that their role is going to be a little bit different when they're advising on a direct listing versus an IPO, because it sounds to me direct listing is really market price is being discovered on the floor itself, not necessarily underwriters telling you what range to expect.
Right, that's accurate, but the financial advisors still do a lot. If you look at it by contrast to what they would do in an IPO, where they do, they have three major functions. They help advise the company with its disclosure and positioning in the market. They take the company on the roadshow and do the price discovery sort of underwriting process, and then they help make the market in the stock. In the direct listing, all they're losing is that middle function, so they're still helping position the company.
All right, and do you think we'll start to see more direct listings? Are you seeing a lot of interest from companies to go that route?
Yeah, we're seeing a ton of interest, absolutely, in particular from the West Coast VC community and their companies. Also, to some degree out here on the East Coast. I think we'll definitely see more. Hard to predict how many, and frankly, we'd be best off if they get rolled out, with some deliberation to make sure we get quality candidates each time. All
right. So, and my next question to you: how do you see the direct listing market evolving?
Well, I'd say there that it's a fabulous time to be a capital markets professional, both a lawyer or a banker. I think we're going to see innovation in the direct listing front itself. I mean, the one thing that everybody's talking about right now is if we'll be able to figure out how to graft on a primary component, which will take it full circle, and the company will be able to raise proceeds, taking away the big negative right now. But I also think we'll see features of the direct listing bleed over to the more traditional IPO path as well. We'll see more flexibility around lockups. We'll see more creativity around investor education. I think it's a great time.
I think 2019 certainly was a catalyst towards that?
Absolutely, yeah. I mean, I think Spotify was the perfect company to move first. An iconoclastic founder, a very visionary CFO, a company that had already disrupted its own industry. It was the perfect first mover, but it was really great to see Slack go, a more traditional, homegrown, venture capital-backed technology company.
All right, Greg, thanks so much for joining us.
Thank you for having me. Yeah.
That's Greg Rodgers, his partner at Latham Watkins, and I'm Jill Malandrino, global markets reporter at Nasdaq.